Have you ever sat there completely helplessly just watching your portfolio drop for the second or maybe third time in a decade? It feels like you're completely at the mercy of the market, doesn't it? It's literally the worst feeling. But what if you could actually shift from being a passive victim to an empowered tactical trader? Well, let's dive right into this. Today, we're unpacking the core strategies from Mark Larson's book, Big Money, Less Risk. We're going to explore his active management philosophy, which is really all about taking total control of your financial future. And the best part? Larson doesn't just feed you theories. He gives you a highly structured toolkit, technical indicators, option mechanics like the Greeks, and the probability of expiring, so you can actually make your money work for you. So if you're ready to stop hoping the market goes up and start knowing exactly how to navigate it no matter which way it moves, you are in the exact right place. Let's get into it. Here's our roadmap for today's explainer. First, the two money bags. Second, multiple moving averages. Third, setting stops with ATR. Fourth, the Inertia Indicator. And finally, the VIX Fear Index. Let's build that tool belt. Section 1. The two money bags. Before we even think about looking at a single stock chart, we absolutely have to rethink how we divide our capital. You can't treat all your money the same way. You need to divide it into two very distinct bags. Over on the left, we've got the Get Rich bag. This is strictly for your high-risk, high-reward directional trades. Think buying call or put options, where you're using leverage to capture massive rates of return. But listen, if you're wrong here, you could lose that entire investment. Now, over on the right, that's your Stay Rich bag. This is your conservative capital. This is where you leverage option mechanics, like understanding the Greeks and the mathematical probability of an option expiring worthless, to generate steady, consistent income. You're using strategies like covered calls to collect premiums on stocks you already own, or putting on vertical spreads and iron condors. These are multi-leg trades where the stock can go up, down, or just trade completely sideways, and you still walk away profitable. Now, the absolutely crucial point here is that number, 10%. Your Get Rich bag should never, and I mean never, exceed 10% of your total stock market net worth. Seriously, if you have $100,000 invested, only 10 grand goes to those aggressive option plays. Why? Because if a trade goes totally south and you lose it all, it is not going to affect your family's lifestyle. You keep your discipline, you take those smaller wins from the Get Rich bag, and you funnel those proceeds straight back into the safety of your Stay Rich bag. Section 2. Multiple moving averages. All right, now that our capital is safely structured, let's grab the first technical tool in the belt. Think of moving averages as a system of safety nets for a dropping stock price, or alternatively, ceilings of resistance for a rising one. To kick things off, Larson introduces this really fantastic, catchy tool he calls the Do It Indicator. It was actually named by two of his students. They found that when all the other signals out there were just confusing them, they could rely on the crossing of the 10-day and 20-day simple moving averages, which, just track the average stock price over those specific time frames. When the 10-day crosses upward over the 20-day, boom, that is your short-term bullish momentum telling you to do it and buy. And when it crosses downward, that's your clear signal to get out. It's brilliant because it gives you the absolute confidence to pull the trigger without constantly second-guessing yourself. Now, for a wider view, we obviously need multiple nets. Looking at something like the S&P 500, we aren't just looking at one line. We're tracking the 30, 50, 100, and 200-day moving averages. As a stock or an index starts to fall, it's systematically going to test each of these levels as a floor of support. If it drops below the 30-day, guess what? It's heading right down to the 50. If it breaks that 50, it's falling to the 100. It just keeps pushing downward until one of these safety nets finally catches it and holds. But what happens when those shorter nets fail? Well, it looks a lot like this scenario for Garmin. Notice how the price just breaks straight through those shorter moving averages and plummets right toward that thick, dark line down at the bottom. That is the critical 200-day moving average. The 200-day is your absolute, ultimate long-term support. Larson always points out that if a stock, or a major index for that matter, drops below its 200-day moving average, it is literally goodnight Irene. You'll very often see the largest, most violent drops begin the exact day that line is broken. When that happens, that's your definitive signal to move to cash and just weather the storm. Section 3. Setting stops with ATR. Okay, if you've ever been stopped out of a trade way too early, or maybe you held on way too long and watched your money just vanish, this next tool is going to completely change your life. Larson gives us this harsh but super necessary reality check using an old Google stock trade from his book. He says, you should be willing to give up $24.51. Now, what does that actually mean? Well, based on the average true range, or ATR, Google was naturally fluctuating by exactly $24.51 per day over a 14-day period. If you go and set your stop loss tighter than that normal fluctuation, you're going to get kicked right out of a perfectly good trade just from normal daily market noise. You have to mathematically accept a planned loss to avoid taking catastrophic emotional ones later. So let's break down exactly how this unemotional shield works. The ATR simply measures the average daily price movement of a stock. But the really crucial thing to understand here is that market volatility changes exactly like the seasons. During a nice, steady, bullish uptrend, stocks move a bit slower, right? So the ATR is lower, which allows you to set a much tighter stop loss. But during a nasty downtrend, or say heading into a major earnings report, panic and excitement cause that stock to swing wildly. The ATR expands, and that's the math telling you to widen your safety net so you don't get prematurely shaken out of your position. Section 4. The Inertia Indicator. Moving right along, out of the over 200 technical indicators out there, Larson calls this one his absolute favorite method for confirming long-term momentum, and he uses a brilliant American football analogy to explain it. Just imagine the 50-yard line right in the center of the field. In trading, the opposing teams are the Bulls and the Bears, and they're constantly fighting for control of that line. If the inertia indicator is above 50, the Bulls have the ball. That is positive inertia, and the long-term trend is safely up. But the very second that indicator drops below 50, the Bears have stolen the ball. The momentum flips to negative, and the odds of the market dropping become incredibly high. Let's actually see this in action on Wynn Resorts. Right where that inertia line crosses down through the dotted 50-yard line on the bottom graph, the Bears take over. Now, look straight up at the stock price trend above it. That exact crossing perfectly predicted a massive multi-month drop in the stock price from $150 all the way down to $95. By simply watching that 50-yard line, you would have known exactly when to shift from bullish call options over to bearish put options. It's a real game changer. Section 5. The VIX Fear Index. All right, we have reached the final and perhaps the most powerful tool in Larson's belt. This is your ultimate contrarian secret weapon. I want you to burn this rhyme into your brain. When the VIX is high, it is time to buy. And when the VIX is low, it is time to go. The VIX measures investor fear. When fear is skyrocketing and literally everyone is panicking, stock prices generally bottom out, which means it's actually the perfect time to buy. But when the VIX is low, it means investors are complacent. They feel totally safe. And historically speaking, that is the exact moment the bottom is about to completely fall out of the market. To put that into perspective, this is what fear actually looks like. Here is the VIX mapped out over a year. Look at those distinct valleys circled down at the bottom: October, December, and May. These are the moments of lowest fear and the absolute highest complacency. As Larson always warns us, when it's low, look out below. And here is exactly why you need to look out below. This is the Dow Jones corresponding to that exact same time frame we just looked at. Notice that first circle? In October, the Dow hit a record high of 14,200 right at the exact moment the VIX was hitting a deep, deep low. The market felt incredible, nothing could go wrong, right? But the VIX was secretly screaming complacency. Within just 7 weeks of that high, the Dow plummeted 1,500 points. That VIX low was literally the calm before a massive storm. So the absolutely crucial point we're left with today is a pretty simple question. Is your money working for you, or are you working for your money? We've just walked through an entire masterclass on shifting from being a passive investor into an active, empowered tactician. By dividing your capital into those get-rich-and-stay-rich bags, leveraging option mechanics like the Greeks, calculating the mathematical probability of expiring, and by arming yourself with moving averages, the ATR, inertia, and the VIX, you finally have the tools to actually define your risk. You can strip the emotion completely out of your trading and mathematically measure market fear. You literally no longer have to watch your portfolio fall in total confusion. You have the knowledge now, so it's time to get out there and put it to work.